jump right in and share my screen, and we'll kind of talk about what's going on with mortgage rates today. So bear with me one moment while I move this over, and we will go ahead and get started. So right now we are at looking at the bond market. We're up 5 basis points, and that's a good thing for us. It's not very much, but look where we've leveled off above this Fibonacci level. So we're in a good place right now as far as where rates or the bond market is kind of in a pause mode. Not very much volatility the last couple of weeks, so rates have stayed somewhat flat. Let's kind of have a look at where rates are on average right now. The standard 30-year fix, we're looking right around the 6.64 range. 15-year right around the 6, 30-year jumbos right around 6 as well. ARMs, look at that, they're almost the same as a 30-year fixed. You can get lower on the ARMs by paying points. There's a little bit more of a benefit when you buy down ARMs than there are when you buy it for the same amount of money. You can get more of a buy down there. But FHA's in the low 6s, so we kind of came out of the 7s, which is a good thing. It's a really good thing, and we're hoping that we can get some real impacts to lower the interest rates coming this Thursday, which I'll dive into in just a second here. So want to go over this real fast as far as where we are in the bond market's impact and what is going to be happening this Thursday. So I'm going to share my screen again with my little PowerPoint presentation that I put together. So bear with me as I do that. Dun, 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 dun. All right, so I want to kind of go over we went through Thanksgiving, right? We're thankful for things. I want to share with you a little bit about what my why is, and then we'll go into mortgage rates a little bit more, and then FICO scores to follow. But here's my family. If you guys want to know what my why is, this is my wife and my 3 kids. You may not have seen this side of me, but this is my family. I've got my oldest son on the left, who's somewhat of a hick. He thinks he lives in Colorado or Wyoming or something. But my wife Amanda, and then my youngest son Hunter here. He's the football, and then my middle child, my star, my little Sydney. She's the singer and the songwriter and the guitar player. So there's my why, and there's me and my wife. We always like to have a good time together. But I'm not sure if you've ever seen my wife, but she's very introverted. And then there's my 3 kiddos. So if you ever want to know what my family is about, there they are. There's my kids. And here's my team. That's my other family. Top 1% in the country since 2016. So super excited about that. But this week, so the Fed President James Bullard right now, actually 12 o'clock Eastern time, he's going to be talking and kind of mixing up the markets. He's the one that thinks we need another 325 basis points more in the Fed funds rate as far as going up higher. So that should stir up the markets a lot today. Tomorrow we have Case-Shiller appreciation. And I don't know why there's that Friday in there. I disregard that. This Wednesday is the Fed Chair Powell is going to be speaking again. That's going to mix up the markets. And then this Thursday, the headline PCE, that's a personal consumption expenditure. There's 2 types of inflation measure. There's CPE and PCE. Now, CPE is what we saw a couple weeks ago come out, and the inflation was lower than normal. Well, the PCE is what the Fed likes the most. It actually doesn't have the amount of real estate and household expenses in there is much smaller in the PCE. And housing actually was a big part of why inflation numbers were so high. So we're expecting this Thursday, the PCE numbers to come in really low. That is going to have a very good impact on mortgage rates. Remember, inflation is the enemy of interest rates. So we should see a little bit of a bump lower in interest rates this Thursday. So if you have any customers that are looking to lock, do not have them lock or talk them into talking to me, because this Thursday we should see rates come down. And then Friday, unemployment numbers are going to come out. They should tick up to about the 3.8 from where they are at 3.7 right now. So that's a little update on what's going to happen this week in the markets. But this Thursday is going to be a good. We already looked at rate slides. A good day. It's going to be a really, really good day for interest rates on Thursday. So in saying that, interest rates are impacted heavily by credit scores. So credit scores have a major impact on the rate. And I want to go over this in detail because if somebody has a 720 credit score, having a 740 could get them an 1/8 to a quarter better in rate. And what we can do to help boost those scores is a lot. So I want to go over some truth regarding FICO scores to help you guys answer those questions with your customers, because first off, there's a lot of misnomers. So FICO stands for Fair Isaac Corporation. There's actually multiple FICO scoring models. We can go into that into a different topic or a different class, but FICO is the Fair Isaac Corporation. So if it doesn't say it's a FICO score, it may be a Vantage score, maybe some other scores, but they're not as accurate compared to what we use on the mortgage side, which is a true FICO score. So this is an interesting, I want to show you kind of what part of your FICO scores are impacted by certain things. So if you have new credit, that's 10% of your score. Length of credit history is 15% of your score. A credit mix, meaning a lot of different types of credit, installment, revolving, that type of thing, the different mix is very important, but only 10%. Payment history is 35%. That's late payments. They're a huge impact. In fact, one late payment can hurt you by almost 150 points. I mean, it can go up to 150 points just by having one late payment. And the amounts you owe is 30% of your score. So a lot of people think that having a new credit card could impact it severely. That's not the case. It's only 10%, but we'll go into a little bit more of that. So there's a lot of questions on multiple inquiries and what that can do to your credit score. And this is important when shopping for mortgages. So the first myth is multiple inquiries will hurt my credit score. And that is absolutely false. It is, but not with mortgages. And let me explain. So when you run your mortgage credit score with one lender, the scoring model will see that if you run it again, it'll see that you had one within the last 30 days, and it will ignore that as an inquiry. So you have a 30-day window to rerun your credit score. And guess what? That next time it's run, that resets it for another 30 days. And if it sees that credit pull from 28 days ago, it'll ignore it again. So when you shop for a mortgage, multiple credit hits will not impact your score. I want to make sure that you understand this so you can share this with your customers. There's a lot of really good information on myfico.com if you ever want to go there. It's by far the best resource for truth when it comes to credit monitoring and credit scores. So if they are rate shopping, multiple credit report pulls within a 30-day window will have zero impact on your credit score. So I want to make sure. Now that's good for mortgages. Now, credit cards, installment debt, like car loans, totally different story. A mortgage credit pull has a different code and it's looked at differently. So I want to make sure that you can share that with your customers, because a lot of times they'll pull it with their bank and they'll be like, no, I have to use my bank. They already pull my credit. I don't want my credit score to drop. That is a myth. Myth number 2, closing an account will help your credit scores. This is absolutely false. What that does is it eliminates all of the good history that you've had with that credit card from your scoring model. So let's just say you had a card and you haven't used it for 20 years. And you're like, why do I even have that? Closing out on that account will actually hurt your credit score, because that shows proof that you can maintain and manage a credit line for a long period of time without having any late payments and without going into any trouble. So closing that will actually hurt your credit scores. This is a big fallacy, a total myth that a lot of people that are in the older age group have thought for years would help them by closing their accounts, when in fact it hurts. A credit score is no more, it's an actual report card on how well and how long you manage open lines of credit. So if you close them all out, you have nothing to score and you're going to get a poor grade. So terrible myth. I wish more people knew about credit, but now this is another interesting myth out there. A lot of people think you average the scores and that's how you get what your credit score is that's used, and that's not true. But it's partly false, and let me explain why. Back last year, the mortgage industry adopted an average or median score for qualifying purposes. So you could have somebody with, and in this case, a 750 and a 610, and their middle score, if you drop the highest and the lowest in this little scenario right here, their middle score is a 730, and this person's middle score, you drop the highest and the lowest, is a 610. So you drop the highest, drop the lowest, their middle score is what we as lenders use for the rate. That's what the pricing is set up. However, for qualifying, we take the average. So there's two pieces of it. We drop the highest and lowest for each person, and then the lowest of that is what we use to give the pricing and the rate for the borrower. But for qualifying, you could have somebody with a 600 credit score qualify, even though the minimum credit score for qualifying is a 620. Now the system reads an average. So you can have a 600 credit score on a borrower and a 730, and their qualifying score is now a 670. Oops, sorry about that. So that was a change that happened last year. It was a quiet change. Not a lot of people saw it, but it is something for qualifying. So if one party has below a 620, you can still get a conventional loan. The pricing is going to be terrible because it will be based on that 600 credit score, but that is a partially false statement. Now, having a great job will help your credit score. This is near and dear to my heart because for some reason, and you might know this as well from seeing your customers, doctors are notorious for not paying their bills, but they make good money. So a lot of times they think, well, I'm a doctor, I have great income, doesn't matter what my credit score is, you should know that I have the income and have a great job, so I should be able to get a better rate. Unfortunately, that is not the case. Having a great job or great income has absolutely nothing to do with your credit score at all. So income has zero to do. So you could make $1 million a year and just be terrible with management of your bills and have a terrible credit score, even though you can pay everything 10 times over because you have tons of income. Doesn't matter. It has nothing to do with your income at all. Myth number 5, owning everything free and clear shows you're responsible and will give you a higher credit score. I have a lot of older customers that are in their 60s and older that think, you know what, everything's paid off. My house is paid off. My cars are paid off. I've got money in the bank. Everything's paid off. I don't need credit cards because I've got cash. I'm the perfect borrower. In reality, they're the worst borrower because they have zero credit history at that point. So having no open credit will actually hurt your credit rating and give you a lower credit score or sometimes no credit score. And if you have zero credit score, guess what we look at? We can still approve you with alternate credit lines like using your Verizon wireless bill, etc. However, for pricing, we use the lowest credit score model at a 620 for conventional to give you your rate. So you're going to have the worst rate possible. So I know that there's some people that tout having, cutting your credit cards and having no credit is fine. Dave Ramsey, huge on this. Not having any credit is fine, but you're going to get the worst rate possible when getting a mortgage if you don't have a credit score. So owning everything free and clear, not having any credit cards, it's actually bad for credit scores. Because remember, credit score is a report card on how well you manage open lines of credit. And if you don't have any, you're going to have a failure grade. Failure grade is basically a 0 or no credit score. So having millions in cash, a lot of people do this. They're like, you know what? I don't need a credit score. I've got $1 million in cash. For the mortgage side of things, it has no impact on your credit score. Having millions and millions of dollars and then going to get a mortgage and you had 3 late payments on something in a collection, having millions of dollars will not overcome the fact that you have terrible credit. So unfortunately, that has no impact on credit either. And I run into these questions quite a few times. So these are all myths that I hear daily. Now, there is something called the Ultra FICO, which is a personal volunteer program where you can link your checking, your savings, and your money market accounts to a FICO scoring model to help boost your credit scores. Now, it's not going to help you for a mortgage because we don't use those models, but it's called Ultra FICO. If you want to look into it, it's really interesting. It may help you with some other retail and for different auto loans, but for mortgage model, we have not adopted that yet. So it's called Ultra FICO. Ultra FICO. So check that out. Myth number 7, lenders can help you boost your score. This is not a myth. This is sometimes true. Now, I want to tell you it's sometimes true because most banks, credit unions, will never do this. So this is something that a bank or credit union will never help your borrowers with. But if you're an independent mortgage banker like myself, we have the ability to have relationships with the credit bureaus and have a program where we can use their software to update and boost their credit scores. And it only takes 3 days to get a better score. That's when you have somebody with a 720 that I know I can get to a 740. I can get them to a 740, get them a better rate, and have an overall better terms, et cetera, compared to a bank would be able to do. Now, I have FICOBoost.com. So if you go to FICOBoost.com, it is a free program. Anyone can sign up for it if they're buying a home to go in, and I will then run their credit. I'll do a rapid rescore. I will improve their credit score and misspell it on my PowerPoint presentation as well. But I will improve their credit score to get a better rate, and there is no cost to the consumer. So FICOBoost.com is the program that I use for that. FICOBoost.com. So it's a silly splash page right now because I'm revamping my website, but it's going to be a lot more robust in the next month or so. How to build credit. This is a question I get for a lot of people on credit. If you have first-time home buyers that have low credit because they either don't have very much, or what they do have, they may have a late payment on. So it's the only open lines of credit are one with a late payment. A good rule of thumb is if you pay off everything to 30% of what you can borrow, you're going to get an optimal credit score or something close to it. Now, it's not exact science, but it's a good rule of thumb. Obviously, don't be late on anything. A late payment has the biggest impact on your credit score. Multiple credit card inquiries in a short period of time will have a pretty substantial hit on your credit as well. So if somebody is trying to get credit cards while they're trying to get a home, apply for a mortgage, and they're trying to apply for multiple credit cards, that could have a pretty significant impact. Pay off and avoid any collections. Do not keep a collections for a long period of time on your credit. They will continue to refresh and continue to post with new creditors that buy that debt, and it will continually have a negative effect on you. I know sometimes people get emotional, like, I'm not going to pay this. It's not my fault. Well, guess what? It's going to impact you, and the creditors don't care. So I would pay those off sooner rather than later, because it's just going to get worse as different collection agencies buy them and add more fees, etc. A great way of boosting your credit score is to get a new credit card and wait 6 months, whether it's a secured credit card by your own money, or if it's a new credit card like a gas card or a Costco card. A great way of boosting it, but that takes time. A fast way is add yourself as an authorized user to any family member or significant other. You'll instantly adopt all of the credit history for them. It's not going to be exactly like it's yours, because it's going to be a passive or a shared account or authorized user account, but it does help. So that is a short-term, very quick way to boost your credit scores. Open a secured credit card. We talked about that. A secured credit card, basically, if you have $500 cash, take it to a credit union, say, I want a credit card against this cash. They take that money, they give you a credit card. It's against your own money, so they'll give it to you no matter what your credit is. So it's easy to get. And then make sure you're asking them, telling them that you want them to post that to the credit agencies. Sometimes they don't, so make sure that they're doing that. And then you can also add utilities and rents to your credit reporting to get credit scores boosted that way and get credit history that way. So a lot of things we can do on credit, and a lot of people don't understand all of the nuances that go behind a credit score or a FICO score. And the biggest question that I see is, well, and I'm going to stop sharing for a second. Customers come to me and they say, guess what, guys? I've got a 620 credit score now. And they tell me, oh, no. I'm like, yeah, that's great. That's fantastic. You got a 620. Well, how did you get that credit score? And they say, well, it's my Discover card gives me a score. And I say, great, but you're also going to discover that when I run your credit score, it's a different model, and it's probably going to be 30 to 50 points lower than that quote unquote credit score that you get. So those credit reports that you get from your credit agency, or your credit cards, they're a good barometer for what your credit scores are doing, but they are not a FICO score. So a FICO score has multiple models. The mortgage FICO score we use is much more strict on different things. So It's way differently in the algorithm. So yes, you can use those to gauge kind of what your credit scores are doing, but they are terrible when you go to a mortgage company and say, hey, this is what my credit card tells me. And then you say, well, guess what? It's actually 580, not 620. Well, they're going to instantly think because you ran their credit, now they have a lower score. And that's not the case. So customers need to be educated the fact that those scores are terrible. They're usually about 30 to 50 points off a actual credit report that's run with a mortgage company through a true FICO scoring model. So really interesting how credit works. It's really the worst system on the planet when it comes down to the frustration with customers have because they just don't understand how credit works. Nobody's taught how credit works. We go to school, nobody's ever taught this in school, but it drives our lives. So it really is frustrating on my side because the amount of different ideas that people have on how it works varies so tremendously on a daily basis that we spend a lot of time talking about these topics. But I want to open it up real fast to see if you guys have any questions on what's happening. How long would one late payment affect your score? Up to 7 years. Up to 7 years. Statutes of limitations don't go beyond that, but if there's a late payment, it will stay with you for a long time. Now, the longer it goes, the less of an impact it has on your credit score, because time is the best healer of anything credit related. But one of the biggest frustrations people have, or not frustrations, fallacies, I guess, myth, is that medical collections doesn't have an impact on an FHA loan. That's true, but it still has an impact on your credit score. So with FHA approvals, they ignore collections that have to do with medical. So they don't have to be paid off prior to closing if they're medical. However, it still has a massive impact on your credit score. So collections, if you leave them there a long time, they're going to have a massive impact on your credit score. So just do everyone a favor, put your pride aside, even though it's not your fault. Pay those collections when they're low, because it will have a bigger impact on you financially over the long run than just paying it off up front. As an example, if you have a collection and you're like, screw it, I'm not going to pay them that $150. It's by principle, I'm not going to pay it. Well, your credit score may go down to a 680, and you get a car, you go buy a car, and your rate, instead of being 2.99 is now 4.99. You're paying $250 a month more in your payment or something. You know, it's going to hurt you more in the long run. So just take my advice. I see it over and over again. Just pay that little thing, get it out of the way. And then also disputes. Disputes don't really do anything for you when it comes to the mortgage process. Now, let me explain to you. If you go to a credit repair agency, all they're going to do is dispute everything. Well, guess what? If you go to a credit repair person and dispute everything, and then a month later go to a mortgage person, most likely a majority of those items will need to be removed and out of dispute so that we can get a proper score. Because it's in dispute, it's ghosted. It's not part of your actual score. So in order for us to get a correct score, we need to remove all of those disputes that you paid that other person to put on for a while. And a lot of times the reason you get a higher credit score when you start those collection of the credit repair is because those are disputed now. So your credit score is going to go up because they're now ghosted. So really, you can never take off anything that's actually happened from a credit report legally. As an example, there's a lot of people that say that they can remove bankruptcies from credit reports. It's still public record. I can remove a foreclosure from a credit report. It's still public record. Like there's still public record saying you have these incidents. So don't believe all of the hoopla behind credit repair. There are some agencies that do a really good job at it. But it can be a very expensive thing. And there's nothing a credit repair company can do that you can't. So you can do the same thing a credit report just by writing letters, Microsoft Word, sending it to the address. You can do it. It's just once a month you do it, every month until they make a mistake and don't respond. And that's how they get it removed. So you can do this on your own. So any other credit related questions that I can help answer for you? I know this is the holidays, and there's going to be a lot of credit happening right now. So if you have any questions on that, and by the way, guys, over the last 3 years, credit card usage is at the highest it's been for like a very long period of time, like over the last 20 years. Part of it's because population increased, but there's a lot of credit use right now, which has a lot of people scratching their heads and hoping that there's not going to be anyone hurting because of it. But we all got into a pretty significant spending trend whenever all the free money was being pushed into our economy during COVID. And I think people are waking up and changing their habits now, but they relied on those credit cards for a little while. And I think that's going to have an impact. And that's probably why we're seeing such a high credit usage in the last 12 months. But quick recap, this Thursday, we're going to see rates drop. Mark my word, I'm looking into my little crystal ball. And the reason I know this, we're going to be replacing a very high number of inflation from last October with a low number for this October, which brings the overall average down. And that's what we're going to see coming out on Thursday. So keep your fingers crossed that there's no surprises, but I'm pretty certain with gas prices coming down a little bit and with housing costs coming down that we're going to see a good CPE coming out. So any questions, guys? Don't be shy if you have any questions on credit.
Where would we get that CPE number if we want to look at that Thursday?
That's actually going to be all over the news. So it's going to be everywhere. But if you want to go to, if you just Google CPE, then you'll see that. And I'm sorry, PCE is this Thursday. PCE, personal consumption. Excuse me. If you just PCE in Google, BEA.gov data. There you go. It's the first one on Google. So PCE. It's going to be a good Thursday, I believe. Most people in the industry think that. What am I concerned about at this time? Interesting. Interesting question. I'm concerned about a lot of things. I'm concerned about people not moving because they have rates in the 3s, which is going to lower our overall inventory. I'm concerned about potentially a lot of people on hold going to be listing their homes a lot at once for this spring, and because they're on hold through the holidays. But I'm not concerned because I have a slew of people that are on hold wanting to buy. And I know when rates come down, there's going to be a little bit of a craziness. So I think this spring is going to be a lot more inventory. I think it's just normal that happens just because we're coming off of the slow holiday season. But I think it's going to be short-lived because just think about it. If you have a rate of 3.25 or 2.75, would you look at your neighbor's house that's for sale and say, you know, they have all those upgrades. That house is so much nicer, has a pool. Let's sell ours and buy that one. You're probably not, because you're going to be in the rates in the 6s now, and you have a rate in the 2.75. It's a much better business decision to just update your home. So you're going to see a lot more people fixing up their homes and not moving, which is going to lower the amount of inventory in your markets and take away that inner city moving. I think you're going to see a lot fewer of people doing that unless they're forced into it because of a larger family, having kids, and then they're going to be like, well, I need the room. This is not working. And then you're going to see those. But I think the amount of people moving, unless they're being transferred out of state, is going to be significantly lower, which is going to lower the amount of listings as well. And then guess what? Supply and demand. If there's not as many homes on the market, those that do need them are going to have fewer to choose from. So I think it's an okay market. It's just a lot of people are scared because of the rate boost, the rate bump that we've seen, and they think 2008 is happening. So everyone's on hold and waiting, just a wait and see pattern. But time will show that the markets aren't crashing. Yes, the markets have come down a little bit, but they had to. I mean, people are paying 10 to 15% over asking for a home. I mean, it was crazy. And all those people were not first-time home buyers. They all had money, so they're not going to walk away from their homes. I mean, there's a lot of cash buyers, people paying ridiculous amounts over, but they're paying cash. So they don't care. They can afford it. They just wanted the house. So they're not walking away. So there's not going to be any crazy 2008 issue, and also the mortgages that are happening now, people can afford them. So Michelle Witten had a question. Normally pay off balance every month until a couple of months ago. Now high balances and bringing score down, but making on-time payments. Once you're able to pay them again, how long would it take for the credit scores to go back up? It's almost instantaneous. Once you get your balances back to normal, back to below that 30%, it'll have an immediate impact. And then over time, if you hold those balances for a long period of time, it's going to know a pattern, and it's going to be harder to get those credit scores back down. It'll take the same amount of time as it did of holding those to get them lower. It'll take the same amount of time to get them higher. So I would say, yes, if they're up right now, totally get it. After the holidays, once you pay that down, they should come back very quickly. Usually if you hold a high balance for like 3 or 4 months and you pay it down, it'll get back to where it was in the same amount of time. But good question. Any other questions regarding credit? And again, if you guys have people that have bad credit, I will run their credit, tell them a plan. The problem is a lot of people get really discouraged because the number one reason for low credit scores is not the balances they hold. It's the fact that they've been terrible at paying things on time. And that takes time. The only way to heal those wounds is by not being late for like 12 months or more. And that can take time. And a lot of people just, that's the microwave world, right? Everyone wants it now. I want it and I want it now, like the Charlie and the Chocolate Factory girl. And unfortunately, if you have late payments on your credit, it's going to take some time. The only way to get them removed is get a letter from the creditor stating that that was a mistake. And then I can get that removed and taken off in a couple days. But if it's a true late payment, that was your fault, it's going to take some time to heal those wounds. All right, guys. Well, it's slow right now. So get your phone out, call everyone on your phone that you have on your telephone. Make sure they know what you do, and set yourself up for a good 2023. Use this time to market, redo your business plans, and hope everyone had a wonderful Thanksgiving. Oh, and if you guys like pickleball, we do have a lot of pickleball events coming up. We joined the Desert Ridge Pickleball club there, so we're going to be doing a lot of events up there too now, because I have become a pickleball addict, unfortunately. So,
and if you haven't played and want to play, let me know. Just send me a quick email or a text and I will add you to our list, because we can only have so many at one time. So we'll be doing monthly events and we'll add you to it.
Yeah, it's a ton of fun. If you guys haven't done it, pickleball is great for any type of athlete. You could be the most unathletic person in the world and it's fun, or you could be a super competitive, crazy person like me and you'll love it too. So there's a place for everyone and it's a lot of fun. It's a lot of fun. How was your injury? Yes, I did pull my Achilles. I didn't tear it completely. It was more of a slight rip, about 25% of it. And I am back now 100%. So thank you, John, for asking. Once you're over 40, you can start breaking everything, right? All right, guys. Well, if you have any further questions, then I will be here, and you guys enjoy your week, and let's all keep our fingers crossed and look forward to lower rates this week. This may be the trend to continue to lower rates, but let's keep our fingers crossed. You're welcome, everybody. Have a wonderful day. Again, I'll stay on here for further questions if you guys have any. Enjoy your week, and we'll talk soon.